Good evening, everyone, and thank you for coming. This is the first of two public lectures which we're hosting here at CSER in connection with an ESC-funded workshop, ESC-funded Climate Ethics and Climate Economics workshop on risk, uncertainty, and catastrophe scenarios. We're very grateful to the ESRC for their support. Tonight's workshop is by Prof Doyne Farmer. Now, one of the things that we work a lot on at the Centre for the Study of Existential Risk is how to deal with very unlikely but very undesirable scenarios. And when you work with these, you realize just how little we know and just how difficult it is to apply classical economic models and other kinds of models when you know so little. Now, Doyne Farmer is a mathematician who works in economics, and he is not afraid of asking and tackling difficult questions and challenging what it is that we can do with models. And indeed, he's shown how the false assumptions of certainty that we often rely on in our models are not just limiting, but also actively unhelpful. And so tonight he's going to talk about how we can produce better models for economic processes that will help us to deal with uncertainty and to make the world a better place. Doyne Farmer works at the Oxford Martin School on their project in complexity economics. Thank you, Professor Farmer.
Thank you. Okay. I wanted to say something, since this is a conference on risk, uncertainty, and catastrophic scenarios. I'm going to at least tackle risk and uncertainty. And I'm going to begin with deep uncertainty, Knightian uncertainty it's sometimes called. How do we deal with unknown unknowns? Well, the first thing I would say we do is, if we're behaving properly, is we're cautious. When faced with things we don't know, we should properly be conservative. And just to tell a little story, I remember being once on the market-making desk, this would be in 1997, of Swiss Bank Corporation, and I was talking to some people. My company was considering getting started with doing automated market making, and suddenly I heard everything get quiet. So I look up, and I see that everybody else is looking up, and they're looking at the screen, and what had just happened, there was a rumor that Boris Yeltsin had been assassinated. And so what happened? Well, all the market makers just stopped making the market. The spread widened to be enormously wide because they were uncertain, so they didn't know what to do. And they sat there for a while, and then some more news started trickling in, and then the spread slowly got narrowed up again, and maybe a couple of minutes later, transactions started happening in the market again. So they were properly cautious, but then what did they do? They went out and gathered more data. Once they had some more data, then they knew what to do again, and they went back into action. And so that's along the lines of what I'm going to be arguing for today. And I guess over and over again, as a society, we're faced with problems where we're deeply uncertain about what's going on, and we cope with that deep uncertainty by gathering more information, building a model, and narrowing things down, creating probability distributions where we didn't have them before, and then becoming more certain about what those probability distributions are. And we are evolving something I would call collective awareness. That is, we use models to understand our world. They're collective models because we make them, and different people make them. It's a pastiche of different models we put together. We use those models to understand cause-effect relationships, to understand what our options are, and to understand if we choose these options, where will different options lead us. And as scientists, I think our goal and responsibility is to help people understand those cause-effect relationships so they can make sensible choices about where things lead. Now, I want to distinguish in this lecture three different levels of awareness. One is our awareness of the external environment. Being at Cambridge, one naturally thinks about planetary motion, which was a great example of taking something, well, actually we knew a surprising amount even before Newton, but in fact, a key thing that Newton did here was to understand how to predict the motion of comets which we couldn't previously do. And so, but to fit this into the context of this conference, think about the asteroid grand challenge. Now, what's that? Well, as you probably all know, we run a risk that an asteroid will hit the Earth. It's happened before. Well, it's happened before that large meteorites have hit the Earth, and if a small asteroid hit the Earth, we know there was a lot of problem when a small meteorites hit. If a large asteroid hit, we could have a really serious problem. And so, you know, you might assume that we're carefully looking to screen those. In fact, that's not really the case. If you go look in the website of the Asteroid Grand Challenge, what you'll see is that, well, we can potentially spot asteroids about 10 years ahead, and we can predict about their trajectories around that far ahead. So we could potentially be scanning for all the asteroids, making sure that we were predicting when they would hit, and if they would hit, 10 years is probably enough time for us to do what we need to do with a major effort of society to prevent an asteroid collision. But in fact, we're only aware of the very largest asteroids. We rely on amateur astronomers to spot them. And the Asteroid Grand Challenge is actually to try and be more systematic about that, so at least cover ourselves from getting destroyed by an asteroid. On one hand, we have the capacity to do this. On the other hand, as a society, we don't necessarily marshal our effort to do it in the systematic way that we need to. An unfortunate theme that weaves through this whole business. Another good example is weather prediction. That's an example where we've gotten dramatically better at weather prediction since about 1980. Weather forecasts from the first computer simulations didn't even hold even with subjective weather forecasters until 1980, but around 1980 there was a tipping point. I actually sort of witnessed it because I was an intern working with Ed Lorenz at the National Center for Atmospheric Research. And I remember asking him, well, Ed, how are you guys doing relative to the subjective weather forecasters? And he said in his dreamy way, well, we're just about even, but we're going to start beating them pretty soon. And he was right. Now, the next level, so those are two good examples of where we can predict things about our environment, and we can do them pretty well, at least when we pay attention. Weather being a case of an ongoing, not unusual risk that we face every day. I call it a risk because if you're flying in an airplane, it can become a real risk. But we do it every day, and so it's become a systematic thing that's just part of what we do. The next level of awareness, I would say, is our effect on the environment. And a good example of that is climate change, which is sort of weather forecasting on steroids. And climate change, I would argue, despite all the controversy around our ability to understand climate change and so on, I would argue it's it's a great tribute to modern science, that we can look at something whose serious effects are 50 to 100 years ahead, make at least quite useful predictions about what will happen, and we are engaged in a major debate in society about the way in which we should respond to those predictions. I think increasingly getting close to a tipping point where we will realize how serious a challenge this is, and society will be mobilized. And then finally, and most of what I want to talk about today is a really hard problem, which is our collective effect on ourselves. We actually have some great successes of this in recent history. You know, in the last few years, in Google Maps, for example, you can now punch in where you want to go, and it will advise you about your route, and it takes into account real-time information about what traffic's doing. And one of the things you see is this is actually substantially rerouting traffic nowadays. You'll be on a back road and realize there's a lot of other people on this road with you in a place that's normally vacant, and because Google has just rerouted everybody to do this because there's a big traffic jam somewhere. It's making our traffic system more efficient, and it works pretty darn well. Now, let's contrast this, say, with business cycles. I mean, traffic forecasting, in a way, it's cool, but it's peanuts compared to something as important as forecasting business cycles. Economies make major oscillations up and down, where things change in fairly dramatic ways. And so I show you an example here of a business cycle index. And, you know, everybody here in the room is old enough to have experienced the crisis of 2008, and which was a big deal, but actually it's nothing that unusual. Here we see several examples of crises, financial crises, and we see years from peak employment here, and we see the percent job loss from the peak, and crises that generate 20% drops in employment are surprisingly common. Now, here's a list of financial panics in the US. I came to make this list because I was actually in the Treasury Department of the United States. I had made a large contribution to the Democratic Party trying to get a 1-minute audience with Obama, which I got. You know, the US has the best democracy money can buy. And I had a couple of conversations with people in the Treasury Department. I started walking around this hallway that's not open to the public, and there was a series of portraits of secretaries of the Treasury. And it started out with Larry Summers and said all these laudatory things. And I went back. I was just about to quit when I got to the point where I was now reading about people that were dead when they had put these portraits up and written a little blurb about what they did. Then they started to get interesting because they were much more honest. And they would say, a surprisingly large fraction of them would say, widely praised for handling the financial crisis of X year, or widely denounced for poorly handling this crisis. And I realized there were actually a lot of these crises. The economy can be a bumpy ride. So here are a few examples. The Panic of 1907, which was solved by J.P. Morgan and led to the creation of the Federal Reserve Bank in 1913. Now, I argued that crises are expensive, and I guess I left out my slide on this, but the Dallas Federal Reserve estimated that the crisis cost the US between $6 and $15 trillion. So that's close to, it's about a half a year of gross output for the US. And similar number applies to the world. You know, the crisis is still having dramatic effects in Greece and Southern Europe. And so crises are really expensive things. I mean, one way to think about that is if the crisis hadn't happened, we could have instead just all gone on vacation for the order of half a year, and we'd be about where we are now. So it's an expensive proposition, and as I argued in that earlier slide, it's not just the rich that are affected, the poor are affected most of all. Now, given the huge stakes, how much money are we spending to understand the economy? Well, you can add these numbers up. You get a figure of around the order of $1 billion a year. That's about what we spend on polar research. Now, I'm not arguing that we shouldn't spend more on polar research. I think polar research is really important, but it's a little strange when we have such a high stakes thing that we spend so little on economics. And you know, if you think about it, even if we it's well worth it, given that we're talking about trillions of dollars, spending an extra $1 billion, it would actually help us avert these crises. It would be a great investment. But now, would that funding be effective? Well, you might worry. Maybe the economy is inherently unpredictable. But if that's really true, then why are we wasting any money on economics at all? And well, I'll come back and say a little bit in a minute about what I mean by prediction. You might also worry that there's fundamental limits, like the economy is inherently unpredictable due to, say, market efficiency, and maybe people can't be described by laws. But another explanation is that maybe the culture of economics as it stands can't accommodate funding. Even if we were to pump more funding in, it would not be very effective. And I'll investigate that too. And before I go too much further, I'm going to, in 2 minutes, try and teach you how an economic model works. So the standard template is that you assume agents have preferences and beliefs. You find a fixed point equilibrium where the agents maximizes preferences according to those beliefs. And the key point there is you set things up, you find a solution so their expectations match the outcomes. And that's what equilibrium means in economics. Then in the strong form, these preferences are utilities and the beliefs are based on rationality. And that's been criticized a lot over the last 30 years. So in those last 30 years, the program has been to modify the assumptions one by putting in things like asymmetric information, institutional constraints, perhaps making only some of those agents rational, having goal functions that depart from strict utility functions, lots of things, sort of modifying things one at a time. So that's how economics works in a nutshell. Now, this has led to an approach in macroeconomics called dynamic stochastic general equilibrium models that Andy Haldane dubbed a rocking horse economy. You assume the economy is in an equilibrium in the style in which I said. You derive, typically at great effort, the equations of motions of the economy by assumptions of the type that I sketched a moment ago. And you'll discover that typically when you, if you just let things alone, the economy will just settle into a fixed point equilibrium where nothing changes. So you assume that the changes that we see in real life, think of those business cycle pictures I showed you a moment ago, are driven by shocks raining down on the world. Zeus hurls his thunderbolts, knocks the economy out of equilibrium, and then the economy, like a rocking horse, goes back, starts to go back into equilibrium, and then another set of shocks hit, and that process repeats itself over and over again. Now, here's another example of a business cycle, and so if you believe that that's the right way to do this, then you have to assume that these large deviations that we're seeing from the trend are all being caused by these shocks and would just disappear if the shocks were to disappear. I don't believe that. I mentioned before limits to prediction. There's sort of, these are at least some fundamental limits. The most fundamental limit is quantum uncertainty. We don't have to worry about that here, but it's worth remembering that's the only true source of random numbers. Chaos or turbulence, which is what's driving the unpredictability or the difficulties of making long-term predictions for the weather. Sensitive dependence on initial conditions. Nonlinearities mean that 2 points that start out close together can exponentially become far apart in the future and make things very difficult to predict. There's another fundamental mechanism of market efficiency where you can have a system that's inherently defeating predictions of itself because the agents within the system do things like seek profits. Seeking profits makes markets inherently more unpredictable. So yet another source that we have to pay close attention to in economics, although I will argue that chaos is actually also a very important source of unpredictability in economics. And then finally we have ignorance, which is usually called noise. And in my view, this is usually the biggest source of unpredictability in anything we do. And it's going back to the theme of the lecture, it's by understanding the world better that we so slowly chip away at our ignorance, reduce the things that we put in the noise category, and move them over into the something we understand category. Now, in the kind of dynamic stochastic general equilibrium model I just discussed, noise is playing a major role. And it's worth remembering and bearing in mind that this inherently limits what we can do since shocks are by definition unpredictable. And that doesn't mean that these models can't be useful. They can be useful in guiding us towards better policies. Economists, of course, are well aware of this, and they are trying to move things from the noise column over into the endogenous dynamics column, which means something that we understand the equations of motion of well enough that we can predict what it does. Now, when are non-equilibrium approaches needed? When the beliefs and outcomes are not consistent, when the strategy dynamics, when that happens, I'll argue the strategy dynamics may not settle into a fixed point, and this happens often when agents are boundedly rational and outcomes are not consistent. So I'm going to begin with a simple example of a strategic game to illustrate the idea and then build on it to go forward. This is a Keynes beauty contest, another thing that's appropriate to talk about at Cambridge, given that this is where Keynes is from. And so Keynes once remarked on that the stock market was really like a beauty contest. And what did he mean by that? He meant that in his day, the newspaper would publish pictures of women, and there was a contest then where one could vote on the woman that one thought was most attractive, and these votes would be put into, counted, and if you voted for the most popular option, then you would be eligible to win a raffle for a trip or something like that. And Keynes pointed out that, of course, there's no inherent thing to say that one of these women is more attractive than the other. Rather, the question is, the clever voter will vote for the woman that they think that other people will deem the most attractive. So it's really about a popular fad. And he said the stock market is like that too. Now, let's play a contest that gets at this idea. So the idea is to name a number between 0 and 100. And the winner is going to be the one whose guess is 2/3 of the average guess. So what's your guess? I'll give you a few seconds to think about this. I want everybody to formulate a guess. What number would you pick in this contest? I'm not going to give you very long because I can see that I'm already talking too much and running out of time. So I'm going to press forward, and I will tell you at least an answer that won in this contest. This was an experiment performed by a Danish newspaper where they asked people to just vote for their number. And there was like 32,000 people voted. And so what you can see their votes. This is how many people voted for 100. This is how many people voted for 0. And each number in between has its number of people that voted for it there. Now let's think about this game for a minute. So just start reasoning a bit. If we're going to take, let's think about the people that voted for 100. Now it's a bit of a peculiar vote because if you think about it, if everybody had voted for 100, then the correct answer would have been 66, roughly, 2/3, because the winner is the one whose vote is 2/3 of the average. So that is a losing bet. And in fact, anybody that bet more than 2/3 made a losing bet. So what you see right away is some people are pretty clueless. Maybe they didn't understand the way the contest worked, who knows. Okay, so the first in all reasonable vote is 66, but if you think about it, if everybody voted 66, the winner would be about 50. And you can see, actually, there are people reasoning there. There's a peak there. There's a peak at 66. There's a peak at 50. There's a bigger peak down here. You can see people cascading down the chains of reasoning, thinking about what everybody else is going to do. And the winner was in here at about level 2. And then there are these ones that voted for 0, which, is the Nash Equilibrium. I can tell you this game, meaning it's the guess. If we iterated that reasoning to infinity, it's what we would have landed on. And once we get there, if everybody's guessing that, nobody's going to profit by diverging from it. And in fact, it might be the case if we played this game a lot of times that we would all converge to that. But I guarantee if we played it in the room and I'd raised hands, some of you might even have been in here. I've done this before and I stopped doing it because I don't like embarrassing people. So this was the winner, you know, about level 2 or 3 reasoning. And these guys here, while sort of strictly correct, if these were the idiots, I mean, those are the idiot savants. Because that's not what people do, at least not in a one-off game. Now, okay, as I said, if we play games repeatedly, things start to get more interesting. And I've done a lot of work on this. So when is the equilibrium assumption justified? And I've tested this in the context of game theory. So in a game, what do you have? You have some players, and the players make moves, so you can specify what their possible moves are. And then you specify a payoff matrix that says, if, you know, I make this move and Partha Dasgupta, who's over there, makes his move, and then we look up our payoff and we both get a reward based on that. And then we're going to do this repeatedly, so we're going to play this game again and again. And so what happens when we do this? And let me just say, I'm by no means the first person to study this. Many people have studied it, and there's a rich literature, but we've taken a little bit of a different approach. And so what did we find? Well, first of all, the approach we took is we assume the agents have to learn their strategies, and we go out and we've explored now several different learning strategies. And I'm going to cruise through this at a very high level, so hopefully I get you interested enough to peek at one of our papers if you're curious about this. We then make up the game at random. We just make up random games by populating the payoff matrix with random numbers. And we employ you know, a standard learning algorithm I already mentioned, and then we just see what happens. And we've also applied a lot of analytic analysis to try and understand this. And what did we find? Well, actually, okay, what did we find? We find in some cases they go to fixed points. The players settle down in a place where they just play the same strategy over and over again. But in other cases, we see wilder things happening, like what I'm showing up there, where there's we're looking in some large space where there's lots of possible moves, and we see the players get locked into a cycle where they just go around in a loop, doing the same thing over and over again. Well, that you can kind of shoot down, because you could say, well, if that happened, these players that are all smart, they'll eventually see they're on a loop and figure out what's going on and change their strategy by realizing that the world is just cycling through, which is true, but I'll show you an example a bit later where that loop is happening really slowly. And you may get on it for the first time, and some pretty bad things may happen because you haven't figured out you're there yet. In other cases, you get what would be called a low-dimensional strange attractor. That's the dimension written up top. The dimension goes from 3 to 9, or to 10 to 65. So when you have a 65-dimensional attractor, you're wandering around this strategy space. There's a lot of different strategies the player could play. And you have something that's, to all intents and purposes, completely random, except that you see these funny things, like if you look at the popularity of playing a given strategy, a strategy can be really popular for a while and then become extremely unpopular. This is a logarithmic scale, so 10 to the minus 30 here. Nobody plays it for a while, and then it goes back to being quite popular again. You have these long-range fads, you see bursts, all kinds of complicated dynamics. But nonetheless, there is a lot of, when we've explored these, we discover there's a lot of order in what happens. In two-player games, we can characterize things based on a property of the strategies, which is how much memory do they have of the past, where the memory is actually increasing. This would be complete memory of the past. This is forgetting more this direction, versus, it turns out a really important thing is the correlation of the payoff matrix of the game. And as we vary some parameter that's involved in making up these random games, there are regions where we consistently go to fixed points, as traditional economic theory would tell us we should. And others where we get this high-dimensional chaos that I showed you a minute ago. And still others where we go to multiple fixed points. In other words, where we end up at a fixed point, but where we end up depends sensitively on where we start. So things are really complicated. And the main findings we have is that, well, we can characterize the games by the number of actions and the number of players, and this parameter that involves how correlated the payoffs of the players are and the memory of the strategies. And what we see is that the chaos increases significantly as the game gets more complicated and as the number of players goes up. And in fact, as the number of players go up, if the game's competitive, then chaos is typical. And we've done this now for several different learning algorithms, and we find kind of consistent results. Now, at this point, I realize a lot of you probably don't quite follow what I'm saying. We can come back and discuss this more in the question period, but maybe I can soften the blow by at least telling a couple of stories. So one reason I think these results are pretty reasonable is that fixed points tend to happen when things are simpler. So I'm reminded of when I was 9 years old and I learned to play the game of tic-tac-toe, as we call it in America, or noughts and crosses, as you call it here. And I remember I learned to even go second, playing 0 rather than X. And I figured out there was a strategy I could follow such that I would always at least get a draw. And I was very proud of myself. And for about a day, I felt like a hero. Then all my friends learned that same strategy, and the game got completely boring, and we stopped doing it. So that's a good example of reaching what's called a Nash equilibrium. It's a simple game. You can learn it. Now I'll tell you a joke. So how do two economists play chess? Okay, so the way they play chess is they randomly select black or white, which is a non-deterministic part of the game. And then they argue about who wins under the Nash equilibrium. Because if, it's a deterministic game, there should be known at that point. But this illustrates the problem. Chess is a really complicated game. We don't know what the Nash equilibrium is. Now, in fairness, because I was educated as a physicist, I should ask you, how do two physicists play chess? Well, so they get very drunk. They start moving the pieces around the board at random. And they argue about whether the game is more or less interesting under scalings of the size of the board and the number of pieces, which you'll notice is just what I did in my analysis. Now, okay, so the point of what I've been saying is that if economics is going to be more realistic, we have to break out of this equilibrium mentality that's has effectively gripped economics, I would say, for about the last 50 or 60 years. And to do that, I think the only way is to simulate things. Because the real economy is nonlinear, it's complicated, and the only way to deal with that kind of thing is through simulation. And so it leads us to what's called agent-based modeling in social science. Agent-based models are a class of computational models for simulating the actions and interactions of autonomous agents who could be both individual or collective entities, like an organization or a group or an individual, with a view to assessing their effects on the system as a whole. And as an aside, I want to just say that in my lifetime, computation has revolutionized science. It's been the biggest driver of progress in science. It's been the new technology that's made the difference in physics or chemistry. Why? Because it's allowed us to look at nonlinear dynamics and nonlinear equations. This struck me when I was a graduate student, so this would be about 1976. Stan Ulam, a famous mathematician, gave a colloquium at UC Santa Cruz where I was a graduate student, and he talked about nonlinear dynamics. And he got up and he apologized for using the word nonlinear. He said it's like using the word non-elephant. But the reason we ended up with this strange word, nonlinear, he said it's like calling an animal a non-elephant animal. It's a silly way to label things because almost any real phenomenon we look at is going to be nonlinear. Yet, why do we have such a strange nomenclature? Because the set of problems we could solve until about 1950 were pretty much the things that were either linear or could be mapped into something that was linear. And so when the computer came along, it opened up this whole new world that we've been exploring. And we've been exploring that world in social science too, but much less effectively than in physical science, for a couple of reasons. One is that the elementary processes are not as well understood, so it's much harder to put things on a computer. And the other is I would say just different cultural attitudes that may be related to the first bullet. And I want to just remind everybody, once I say I'm a physicist, people will come back and wag their finger at me and say, but people aren't like atoms, people can think. And I just want to assure you that I know that. I sometimes even think myself. But you know, people do follow rules, and when you start going through the psychology literature, you know, it's amazing sometimes how consistent people can be in their behavior. We're being empowered now by big data and the internet, which is providing us with massive quantities of data about how people behave, much more than we're processing. And the key, as we saw already in this little Keynesian beauty contest I showed you, is to understand the right level of reasoning and to find the correct ways in which people think. Now, so I'm going to give you an example of a non-equilibrium model. I'm going to start by just showing you a result of a big simulation we were doing. We had a bunch of banks. They were managing a bunch of assets. You know, we sort of constructed a bank in a computer, and we pushed go. And okay, we had to debug a lot of code before it's not quite that clean. But then we were generating a stock market index, and it looks kind of random and nice. And we're going, well, okay. But you know, we're really not, these banks aren't managing their risks very sensibly, because we just gave them a bunch of money and let them just start trading, and whatever happened, happened. We said, look, we've got to make them more cautious. So we looked up the Basel II rule for risk management, a rule that was widely started being used in the 90s. And we put it in, and we made all the banks start following it. And what happened was this economy with that stock market index suddenly turned into something with a stock market index that looked like this, where we saw the run-ups, bubbles, and then crashes followed by another run-up and a crash, and that pattern just repeated itself over and over again. So that was a bit shocking. We put in what we thought was going to be more prudent risk management, and instead we got a world with sustained bubbles and crashes coming back at us. So then we said, well, what's causing this? So, you know, we of course look for some bugs. We say, all right, let's turn off the real economy. We switch off the real economy. We switch off, we go down to one asset. We go down to one bank. We simplified everything as much as we could. And then we played around with it and we figured out what was happening. So that's a preview for what I'm going to show you in just a moment. Turns out that what we were seeing here is an example of what's called a leverage cycle. So leverage is when you buy stuff with borrowed money. And this was something that was pointed out by Minsky during the 70s as a big problem. He said that during calm times, leverage goes up, people start borrowing more and using credit more in markets. And as they do that more and more, the economy should get more unstable, and that puts us in a vulnerable place where we have a crash. So he said that in words. 2003, John Giannakopoulos introduced a quantitative model that allowed one to think about this in a two-period setting and coined this term leverage cycle. And actually, there's a long literature on this as well. I don't want to give the impression we're the only people to look at this. But I'm going to now present you a very simple model. It's even simpler than what Minsky or Giannakopoulos did, and just illustrate this point. Explains what's going on in that simulation I showed you. So now what's leverage? Leverage, as I said, is buying assets with borrowed money, and the leverage number that you have is the value of your risky assets divided by your equity. That's divided by what you're worth. So for example, if you buy a house with 20% down payment, that means you're buying the house with 5-to-1 leverage. You put down $20 to buy a house that's worth 100. Well, let's put lots of zeros after that. And you know, it may sound like a crazy thing to do, but many of us in this room have done it, and it's essential for the operation of the economy. Now, during the crisis, we saw a situation where we had, here's for example the stock market. So it goes up, reaches a peak, it comes down again. And during that period, the leverage of, this is of US broker-dealers, slowly goes up, spikes sharply up just before the crisis, and then comes rocketing down. And here we see the volatility of markets. Markets got more and more calm during that period until leverage went up, and then we started to see markets rise, and then just after the leverage crashes, volatility spikes up dramatically. Now, can we explain that from a really, or something like that from a really simple model? So in this model, we have two agents, a bank and a fundamentalist. And so the bank here represents any investor that's using leverage, which investment banks do, and has a leverage target, meaning they have a notion of how much they're willing to borrow to do their business. And we'll assume they have one risky asset, like a stock, and otherwise they park their money in cash. And we're just going to make four simple assumptions. So the first is that the bank is, well, actually, let me show you the diagram to give you a little better feeling for the model first. So here's a diagram for the model. We have a fundamentalist, and the fundamentalist, I should say, is somebody like, Warren Buffett, who looks at buys companies that are undervalued, sells companies that are overvalued, and in particular, if they see a company's undervalued, they want to hold a large position on it because they think the market's going to revert back to the value. So in this model, we're going to assume the value is just constant, and this fund is detecting this mispricing, and when it sees things being underpriced, it's going to buy. And there's also shocks coming in that we can turn on and off here. And so that's what the fund is doing. What the bank is doing, so this is bank is a four-letter word version for, in this case, a leveraged value investor, a leveraged investor with a leverage target that may change through time, is that they have some leverage target they want. They update their risk estimate every time they receive new information, and depending on the risk, they update their leverage by buying or selling. And so now I have to tell you, and actually let me go through the other assumptions in this model. So we're going to assume that the bank uses an exponential moving average of historical volatility to estimate its expected volatility. That is, the bank is going along looking at about 2 years of past data, that's around what people tend to do, and to estimate how volatile the market's going to be going forward. And if it sees the market is getting more or less volatile, they adjust their holdings accordingly, using the Basel II risk management rule, which is also called value at risk, to set their leverage target. So let me go explain that here. So in other words, what this means is if they think volatility is going to go up, then look at this blue curve here, which is their leverage. As volatility gets bigger, they reduce their leverage. When volatility gets smaller, they increase their leverage. Now that's a very sensible thing to do, because if volatility is bigger, that means there's more risk. So they should borrow less money and be on a firmer footing by holding more capital. And so they're going to go along adjusting according to this blue curve as they go along. Just for contrast, this green dash curve is what would happen if they just kept their leverage constant regardless of what was going on outside, which from an individual point of view seems like not the right thing to do. Basel II seems much more sensible, at least if you assume that there aren't other things going on, and we'll come back to that in a minute. Now, okay, what's the third assumption? Well, price formation, we assume that supply equals demand. That's a totally standard thing to do in economics. So we're going to assume that the price clears where supply meets demand. It's not strictly true, but okay, everybody else does it. And it's not so bad. And then finally, we have the fundamentalist who I said buys undervalued assets and sells overvalued assets. So in this model, and let me just state a key fact here now, which is that for a passive investor, that means somebody who's not making decisions for a while, they're just holding their assets and letting things happen. If their leverage is greater than 1, meaning they're borrowing money to buy their assets, when prices drop, their leverage goes up. And when prices rise, their leverage goes down. And to see why that's true, you have to look at the formula for the leverage here, where we look at the value of their risky assets divided by the value of their assets minus their liabilities. When the risky asset value goes down, this hits in both the numerator and the denominator, and because the denominator has the liabilities subtracted off, because this is your equity here, it has a bigger effect in the numerator and drives it up. That's the best intuitive explanation I've been able to find. But this creates a problem, because what it means is that this is destabilizing. That is, if prices drop, leverage goes up, and how is the bank going to readjust its leverage ratio? Well, it sells, the easiest thing to do is sell assets. So it means the bank, the leveraged investor, is going to be selling into falling markets and buying into rising markets, so it's destabilizing. And it's always destabilizing. And this actually, when we were constructing our original agent-based models, we had problems with this because we realized we couldn't make a world that just had banks doing this in it, because it would just blow up. That's why we have to have that fundamentalist there. The fundamentalist is the one who's processing the information and making sure the world doesn't go off the rails. Now, I already showed you that. Now, what happens when you put this model together? Well, depending on parameters, you see different things happening. So this is with the shocks in there. And what we're plotting here is time on the x-axis against price on the y-axis. Or down here, we're plotting leverage against time. And when we set the banking sector so it's small relative to the fundamentalist, meaning that we don't give the bank that much capital to play with, or we don't let them take that much leverage. And then what we see is things go to some place where, you know, the random shocks hit and it just kind of drifts around. But now what we do over in these two panels is we crank up the size of the banking sector. We just let them become bigger. We give them more money to invest relative to the fundamentalists. Or we let them take higher leverage, or some combination of the two. And when we do that, we start to see this pattern that we saw before, where we see these oscillations in prices and leverage along the lines of what I showed you in that earlier slide. So this is the essence of what's going on here. Now, one thing to notice is now the axes aren't just in arbitrary units. This model, these are actually years. So this is year 130 since we started running the model. And what we see is actually now we can calibrate the time scale, and the time scale for these oscillations is the order of 12 years, 15 years, 10 years, depending on how we adjust the parameters. In other words, we're starting to get time scales that match the picture that I showed you before. Now, one of the surprising things is we can turn off the noise, and remember, in the rocking horse economy, it takes the noise to keep things happening. Here we can just turn off all the noise, and what do we get? Well, we now have either just a fixed point, the economy just settles down to rest, or we see this oscillation where we see a boom that takes the order of 10 to 15 years, followed by a bust where things go to hell, and we see another boom followed by another bust, and that cycle just keeps repeating itself, although it doesn't repeat itself exactly. In fact, what's underlying this behavior is a chaotic attractor that we see a picture of here, where we see perceived risk versus who owns the asset, the bank or the fundamentalist, versus the price. We see this cycle repeating itself, but not repeating itself exactly. And if we chop this and take a picture, we see what suggests a fractal, because we can see the stretching and folding on this chaotic attractor that's generating the randomness. Now, back to the thing I motivated with this. Well, I'd argue that what we've shown is that it doesn't take very much to get something that looks qualitatively like this, where you see a slow run-up of leverage, slow run-up of prices, volatility decreasing as time goes on during the boom, followed by a crash where volatility spikes up, leverage crashes down, and prices crash down. And furthermore, we actually took, this model is based on very simple assumptions. We're just assuming that behavioral assumptions, people use exponential moving averages to estimate future volatility. That's just if you just go ask investors what they do, that's what most investors do. They use Basel risk management, value at risk. That's what everybody does. We have a fundamentalist that buys undervalued assets and market clear. Very simple, and I would argue uncontroversial assumptions. Now, so we can't say that Basel II was the cause of all this, but we can say that Basel II plus some realistically high leverages, because we can actually calibrate that model pretty well, compare it to reality, seem to be sufficient to cause that behavior, and the housing bubble may have just been the spark. I think if not that, something else would likely have caused this. Now, let me just reflect on the fact that Basel II was there to protect us. Basel II was a reasonable attempt to protect us by having investors do things that, if they don't understand what's going on systemically, is totally reasonable. When volatility gets bigger, they reduce the size of their holdings to be able to weather the storm. The problem is, because they do all that, they do this in tandem, and because it means they all end up selling into falling markets, they destabilize the entire market. And actually, we've studied this and shown that it's actually better if they don't use that. If they just hold their leverage constant, in the case where the banking sector is large, everybody's better off. Now, I'm going to speculate a little bit. So I showed you an incredibly simple model just because I wanted to make a point. But can't we do this kind of thing more realistically? Well, I think we should be able to do this. So my vision, putting on my Star Trek glasses, is that imagine a real-time tandem simulation of the economies of the major countries of the world. I imagine taking micro big data inputs directly off the internet rather than using national accounting statistics. Coupling this possibly to other social models to make it even more ambitious. I would like to see this being used by central banks, where you'd have a team focusing on what households are doing, and one on what firms are doing, one on what banks are doing. They'd be analyzing the data they're looking at the internet. They'd be examining the details of what their model for that piece is doing to see whether it's consistent with the data that they're getting, and then modifying those models if they're out of whack. And so I'm there painting a kind of a big science vision of where this could head. I just want to emphasize that I'm not arguing that everything should go to big science and we should do nothing but these big simulations. But I think we should have at least one serious attempt to make such a big simulation, given how costly the crisis has been. And even if you think it's a long shot that it would work, I think it's worth doing, because on a cost-benefit basis, even if there's only a 1% chance this would succeed, and if it costs, $50 million to do it, I still think it would still, economics says that it would be a good idea. And I'm not arguing, though, that we should abandon small science. We should do lots of small science still, because only by that interaction do we properly learn. Now, let me just say, we're engaged in tiny little versions of this at present. My group, we're doing a simulation of housing markets with Bank of England. If it had more time, I could have showed you some examples of what we see. We see actually that housing markets are a case where it's easy to get endogenous dynamics where you swing between booms and busts automatically. This happens pretty automatically if you let people starting to borrow too much money again. Same kind of story. As you let people leverage a lot, housing markets tend to start oscillating. But we're trying to make a more realistic housing market simulation, and we've been advising the Bank of England about policies like, should they put restrictions on loan-to-income ratios for banks, which they have done, by the way. We've also been doing a systemic risk analysis of financial markets in general, the Bank of England, the European Central Bank. These banks have the ability to collect detailed data on what each of the institutions are doing, which means that you can actually initialize these models, which is essential to make this kind of thing work. Now, we've also been creating something called the Economic Simulation Library, where we're trying to create a standard toolkit for doing agent-based modeling in economics. We're trying to build Lego blocks that make it easy to deal with agents that have things like balance sheets, that is, they do accounting. which is a central feature in economics, that form contracts with each other, where we have markets, where we have expectation formation. We're trying to build a little toolkit where you can just grab these things off the shelf, couple them together, use different flavors of them, make it all really plug and play and interactive, calibrate against real data, run the simulations at scale up in the cloud. And we're trying to do all this in an open source, sort of wiki economic style, where all the models everything we create just sits there right on the web. Anybody can grab it, anybody can look at it, anybody can examine our code, and where other people, like those of you in the audience who this interests, can participate by, for example, adding your skills as an economist or your skills as a programmer or whatever you like. Now, I have to say that we've had some problems getting funding for this, but we're nonetheless persevering. We also can potentially address a fundamental problem of macroeconomics. You know, there's only about 15 well-observed business cycles in recent and relevant economic history. So in other words, we don't have very much data. And anybody who's done much modeling knows once you reach a point where you don't have much data, you can't build a very complicated model, because a complicated model is going to have too many parameters to fit with a small data set. So I think agent-based modeling could potentially help us get around that by using microdata, because in an agent-based model, you try and construct the economy from the bottom up. So you try and build your model around data about what individual agents do, from things like data you collect on the internet, surveys by the census we've used in the housing models, Facebook, wherever we can get the data. And because you can kind of test the models at the lower level, then you have some hope that when you assemble them at the top level, you can do a better job. But let me just say, it's still a really hard problem. It's really ambitious, and it's not going to be easy to do. I'm getting a little low on time, so I'm going to keep moving here. I haven't said much so far in the lecture about longer time scales, innovation, growth. These are things that are even harder to model than something like business cycles. But let me just say that in another set of research that I'm not going to talk about here, I will actually talk about at my talk at this conference tomorrow, we've been looking at well-known laws that these processes seem to follow. Moore's laws, probably familiar to everybody here. Turns out that computers aren't the only thing to satisfy Moore's law. Lots of other technologies satisfy Moore's law, like solar photovoltaics, for example. It's just that they do so at a slower rate, so it hasn't been quite as obvious. But we've been collecting data on lots of technologies. We have time series on hundreds of technologies now. And there's about 50 of them that improve over time at some statistically significant rate. And we've used those technologies to come up with ways of forecasting so that we can take something like that time series for the price of photovoltaic modules as a function of time, make a forecast by just drawing a line through the endpoints, and actually assign probabilities to the outcomes. That is, this is showing the sort of 1 standard deviation versus 2 standard deviation confidence interval we have that the price of solar photovoltaics will be at, say, 2030. And so this comes, I'm also threw in this slide to come back to this theme about Knightian uncertainty. This is another example where we started out with something where we just didn't know too much about technologies. Now we start gathering some data. We start noticing, there's a pattern. There's this thing, Moore's law. Okay, it applied to computers. We discovered it for computers first because it's so dramatic. Computers improve at 40% per year. But then we start to notice, actually, it works for other things too, like solar cells. It's noisier, but it nonetheless is there, and it's a pattern we see across a lot of technologies that then allows us to forecast things about our future. And this is a particularly important forecast because it's telling us that some of the big problems for mankind, like climate change, there may actually be a silver lining in the cloud. So of course, one of the reasons we need better economic models is for sustainability. Sustainability, you know, how can the economy coexist with the biosphere and continue to grow? So we have to either dematerialize the world more so that we have a smaller environmental footprint, or we have to slow down growth in order to compensate for this. For climate change, we're actually looking at trying to build better models for understanding the effects. I think this is one of the areas where, in my opinion, economics has not done very well. I don't believe even the sign of many of the conclusions in economic models. The slide I just showed you a minute ago about solar cells suggests that we are very likely to have cheaper energy in 20 years than we have now, cheaper than coal. Renewables, I predict, are very likely. We can assign probabilities to this, but the significant likelihood is that energy will get cheaper than existing fossil fuels. You know, fossil fuels have remained constant in price over the last century. We're paying around the same now for coal or oil that we paid a century ago once we adjust for inflation. Whereas solar photovoltaics have dropped in price by a factor of about 3,000 since their invention and first rollout for satellites in 1956. So that's suggesting that we don't even know the sign of the transition to a net zero carbon world. On one hand, we are going to have to pay something up front to get there, but on the other hand, we may arrive at a place where things are cheaper, so when we compute the net present value, there's some discount rate where we actually win by doing the transition. And we're actually in the process of trying to estimate what we think that discount rate is. Now, other kinds of problems that are looming on the future, actually hitting us right now, that we need to do a better job with. The digital economy, it's a remarkable thing. Digital economy, as we see with Facebook, where, you know, my God, Facebook is worth something like $400 billion now. Mark Zuckerberg, at age 31, is one of the richest people on the planet. I can't remember how many employees Facebook has, but it's a few thousand at the most. And they have a virtual monopoly, 2 billion users. Google, Amazon are other examples of monopolies. And why are these monopolies, these strong monopolies, emerging? Because the increasing returns to scale are so huge. Once you have something like that, it costs so little to scale it up to the whole world. And in the case of Amazon, okay, both Google and Amazon spend a lot of money, but they've managed to go sufficiently beyond everybody else that they have a virtual lock, and they've altered the landscape of how we interact with each other, as we see with a wave of populism overwhelming the world and echo chamber bubbles. The way in which we relate to each other has changed as a result of these companies. And I put versus Wikipedia down here just to indicate that there's another different horizon. We have this remarkable thing of this self-organized encyclopedia that also has a monopoly. It's put encyclopedias essentially out of business, but it's doing it under a completely different, and I would argue more benevolent, business model. Though, you know, you still have to worry that Wikipedia, you can read some pretty weird things on Wikipedia. Now, I'm almost wrapping up here. Just to keep rolling out even more to the horizon in the spirit of this conference, I think we should be keeping our eyes more closely on what some of my friends are calling the big technologies. That is, biological technologies. In the next 50 to 100 years, we're going to understand how organisms work. We're finally going to actually understand how biological machines function. And once we do that, the possibilities for bioengineering are going to be remarkable. Information, the quantities of information that we're gathering and are able to store and process now are astronomical compared to what they were when I was a kid. Nanotech is causing cyber tech to go to the same scale as biology. That is, previously you had biology that operates at a molecular scale, and you had human technologies which operate at large macro scale, and we're now slowly moving towards the nanoscale that biology operates on. So we'll have these techs that will be essentially taking advantage of the same rich structure of the world. And finally, the cogno technologies, we're seeing a fusion of machine learning and neuroscience, and we are getting closer to the underlying principles of thought. And these four different technologies merging together is frightening in the dimensions of what it can happen. Now, at the same time, we have strikingly divergent visions of the future. On one hand, we have Bob Gordon, a very, competent economist, arguing that we're in a secular stagnation that we're not going to break out of because the really important stuff got delivered already at the end of the 19th century and the early 20th century, and we've just been building it out since then. And actually, digital technologies, while they're kind of cool, they actually haven't made as big a difference on the world as these other things did. And let me just say, I have a little bit of sympathy for that point of view. My dad grew up on a farm in a remote part of Arkansas where they made their own soap they would kill a pig, take the pig fat, combine it with lye, and make their own soap. They were almost self-sufficient society. Once every week or two, they would harness up the wagon and drive, a couple of hours to a place where they could trade stuff and then drive back. And so for him, the change in the world that he experienced, he eventually became an industrial engineer. It's a dramatic change in his world. So Gordon has a point. But Gordon's arguing we're just going to stagnate because the really important stuff in human needs happening. Okay, here I put at the opposite end of the spectrum Ray Kurzweil, who's arguing we're approaching a singularity where the BINC kind of stuff that I'm talking about is going to cause such a dramatic change that human beings will go extinct because we'll generate these other bio-cyber organisms that will just take off and we can't even comprehend what they're going to do. Now, who's right? I mean, I scarily think that on some time scale, although, okay, Ray Kurzweil, I wouldn't take everything he writes too seriously, but let me just say, I don't think you can reject that kind of scenario either. So somehow we have to bring our science forward to help us think about these worlds. And I started with some simpler things and I layered on more and more difficult problems. We need to do a better job of simulating and taking advantage of our capabilities. And I think we need a new economics with a different knowledge set, different ways of posing and solving problems, different criteria for valuing contributions, and there's a huge cultural shift that has to happen to make that change. And on this note, I will end my lecture. Thank you. Happy to stay here and answer them as long as you are.
Yeah, going back to financial modeling, what is the effect of derivatives in financial markets? So you would expect derivatives to amplify the effects of volatility.
Yeah. Yeah.
Have you modeled it?
We have not modeled that. I've thought about modeling it and I would like to model it more. So, on one hand, there's Warren Buffett's called derivatives weapons of mass destruction. On the other hand, people use derivatives for perfectly reasonable purposes. Southwest Airlines hedges its gas bill by buying futures. Farmers hedge their risk by locking in the price of the crop before they grow it. And people who can afford to take the risk take the other side. It's a good thing. The problem is it can also be used for speculative purposes. And just as I argued that leverage is destabilizing, derivatives in fact, as far as I can tell, they are always destabilizing and they generate a positive feedback. That is, the price effect of exercising a derivative amplifies the risk that the derivative is insuring against. And so they are inherently destabilizing. So like a lot of things, you know, they should be used in moderation. Leverage is a good thing. I'm not saying we shouldn't do it. Just got to be used in moderation. You know, it's like drinking. Just drink a reasonable amount. You know, use a reasonable amount of derivatives. And one of the reasons we need this risk dashboard that I would love, you know, somebody to give me a lot of money to install at the Bank of England is so that we can keep track of where we are, so we can model the dynamics of the market and the risk amplification potential of the market using much fancier versions. Well, not fancier conceptually, actually. Just much more realistic and complicated versions of what I showed you, so that we kind of know where that moderation zone is. You know, Basel III is a lot better than Basel II. Is Basel III right? I can't tell. You know, my sense is it may be overcautious in some domains, undercautious in others, but I can't say. I have a lot of Knightian uncertainty. I want to reduce that Knightian uncertainty by modeling the world properly. Yeah?
I have two questions about the first part of the presentation and this obsession of the economists for equilibrium. So I was thinking that, for example, cycles, they have been in biology in the 30s, Volterra-Lotka. Then we have in the 60s these deterministic non-periodic flows of Lorentz and all the chaotic. So I found shocking that economists haven't learned all those techniques while other sciences have adapted. But then, that would be my first question, why? But then my second question is that my first question is wrong. For example, we have Professor Myrdal working in cycles, feedback loop, balanced loop, all loops, and you have dynamics similar to the style of Ashby in cybernetics. Then, if you have one, for example, agent-based models, you have Professor Hayek. In his book, Law, Legislation, and Freedom, is an agent-based model, the first part, clearly. And both got Nobel Prize in this case, and even if you want evolution, you can have Herbert Simon.
Yeah.
Also Nobel Prize, but none of them are recognized now.
Yeah.
So it's not a fact that they haven't used them, or
no. So there's a history to these things, so I'll try and give a little context. Let me first of all say I'm not arguing economists should not use equilibrium at all. I want to be clear on that. Sometimes, I mean, you showed my diagram, there's a big zone where it works well. And where it works well, it should be used. The problem is that it's because it's seductive to do the mathematics, because for cultural reasons everybody went down that tunnel, that's the thing that's the muscle that's really been developed. And so I just want to make that point, that I don't want to say that shouldn't be done. Now, what's the history with chaos in economics? It's interesting. There was some flurry of hope in the 80s that chaos would be an interesting thing for macro. And there were some people started looking at the time series, and they showed that when you applied time series models that people had developed for analyzing chaotic data, I was one of the people involved in developing those models, that you could not distinguish between a business cycle time series and a chaotic attractor. And so there was no compelling evidence to use chaos. And the problem is because of this, the fact that there's so little data. And we already knew that if you only have a little bit of data, that your only hope for seeing chaos is when the dynamics are really low dimensional. That is when things are really simple. Somehow, if the business cycle were just dead simple, you know, like an epileptic fit time series, that's where you see chaos in the brain. Or let's see, where you see cycles in the brain. If it were dead simple, maybe. But actually, it's just too complicated. So they set it aside, in some sense rightly. Now, the problem is that doesn't mean that chaos isn't there. And in fact, in a model, you can analyze chaos in any dimension. There's techniques for doing that. I also worked, in my thesis, one of the things I showed how to do was just that. And it would changes significantly your conceptual way of thinking about what's going on, even if you can't show in the data that it's sitting there. So it's a bit of a subtle thing, and we'll see. Maybe it will come back now. I think you know, I sense a real openness among economists to new ideas right now. Now, so hopefully I answered both your questions. Yes?
So a question about your proposed program. So in physics and spectral-complex systems, there's often a lot of models that will reproduce important features that you see in data. But the only way to find out which ones are more valid, or a closer approach to physics, is controlled experiments.
Yeah.
Any idea of how you can do controlled experiments?
Well, okay, so this is tricky. First of all, I want to, this is a good point to bring up. The model I gave of the Basel II leverage cycle, again, I said that's one possible explanation. There are other people who have explanations for, certainly for the crisis. And I actually should have stressed a little bit that even for Basel II, there were some DSGE models made by people like, blanking the name, Jean-Pierre Zagrand, sorry, I'm having a blank out for the moment of the names, Shin, and they had some models that sort of suggested something like that too. Those models were in a DSGE framework. They weren't nearly as clean and simple as what I showed you. They were not easy to calibrate against the data like the model I showed you. So I'm glad you poked me on that. Now, back to this. There could be other explanations. It can be hard to do. How do you get at it by something like experiments? Well, one way is actually you do experiments. One of the big changes in economics over the last 10 or 20 years is experiments are now accepted. Economics has had this tendency that people try things that you would, there's a big gate that you have to somehow get through in economics. So experiments, game theory was actually an example. In the 50s, game theory was sort of out in the wilderness and not considered an acceptable thing. It slowly worked its way in so you could get published in the top journals doing game theory. Behavioral economics is another example where it lived in the wilderness for a long time and then finally, starting somewhere in the 90s, it started to come in. And similarly with experimental economics. Now, some of my colleagues like Kars Hamas are doing economics experiments. They're starting to use larger groups. Makes the experiments more expensive, but now you get a feeling for something that might be more relevant for macro, and you can begin to get at the mechanisms of what's going on. Okay, you have to worry about the fact that the experiment may be not a good representation of reality. It's harder to represent an economy in a lab than it is to represent the physical world in the lab, although, just think about the weather. You can't get the whole weather in a lab. You can get little pieces of it in the lab, and that's just what economists are starting to do. So I think we have some hope to get at those mechanisms. We also have hope to get at the mechanisms through just more detailed predictions. You don't just predict one or two hand-wavy things. You actually make lots of detailed predictions, and you experiment with your model to see how the assumptions you've made affect those predictions, and you really try and get a long enough list of characteristics that you can predict that you start to have some confidence that what you're doing is right. There's a beautiful agent-based model by Rob Axtell where he models firm size and labor flows, and I lose count, but he has 30 facts that he can explain with that model in a pretty quantitative way. Now, he submitted that paper over the course of 10 years to all 5 of the top economics journals and was resoundingly rejected by all 5 of them for basically not playing the game. So that's where the problem lies. Yes?
Regarding the cultural difficulties that you mentioned, I wonder, I mean, agent-based modeling has been around for a few decades.
Yeah.
Of course, now it's different because we have much more data, but I mean, we've had data for at least 20 years now, right?
Yeah, right.
Especially since like the semantic web movement and things trying to linking open data. How optimistic are you? You mentioned that you see some cause for optimism, but I wonder what the cause is and what we can do.
So it's a good point, and there was actually Paul Krugman had a statement in his blog I sometimes include where he says, after all these agent-based modeling, after all these years, it's still hype and promises, and I got into it and I tried it, and but after all these years, it's still hype and promises, and he's got a point. On the other hand, if you look at how this has crept into different fields, first of all, the number of, if you just look at the occurrence of agent-based model as a keyword in a paper, it's been increasing exponentially. The real action is not in economics, though, it's in other fields. So for instance, traffic simulation, nobody disputes. That's the way you go. If you want a realistic traffic model, you make an agent-based model. Epidemiology, ironically, good old Dick Cheney pushed it through the barrier, because prior, the models were all couple differential equation models for epidemics. Cheney was worried about what would happen in an anthrax attack by terrorists, and what vaccination protocol should we use. Put out $50 million for funding, and that gave enough impetus that the agent-based modelers could scale up, and now the best agent-based models, the best epidemiological models are agent-based models. Why? Well, because with an agent-based model, you can put in airports and schools and hospitals, and so if there's an outbreak in a country in Africa, you can look at the flying routes. You can actually predict how that disease will enter and the rates at which it's likely to spread, depending on what people do in response to it. So nobody disputes it anymore. Another big application area is defense. Now, what the hell they're doing, I don't know. It's behind closed doors, but it's known that the budgets are huge, and they do big battlefield simulations, and the Pentagon apparently thinks it's really useful. In fields like ecology, it's becoming increasingly more and more used. And you see these examples like Rob Axtell's model that I mentioned. There are little models creeping in economics. So I think it's a hard problem. That's why it's taken a while. It's hard to take microdata and connect it up to the model. It's hard to find the data that you need to have the initial conditions to actually initialize the model usefully to go forward. That's one reason I want to play with the central banks. They have the data to initialize. It's a big effort. It's a little bit like, imagine where we would be. You might suppose physical weather forecasting in 1950, instead of, when John von Neumann basically, he grabbed the leading physical meteorologist, and Jules Charney and von Neumann's wife programmed the ENIAC to make the first weather forecast, which they made in half of real time. And they sort of cherry-picked the situation to find something that would give them a good forecast, and it looked okay. They declared victory. In their case, they had the Air Force, and all the physicists, of course, were behind it. Everybody piled in. They got billions of dollars. And 30 years later, they actually had something that was worth something. But it took them 30 years. Now, I don't think it's that bad with agent-based modeling, because while we don't have the Navier-Stokes equations to sit on the other hand, we have the computing power now. We have the data. We don't have to go out and gather all that like they did. And so I think it could be a much more accelerated thing, but looking at weather, it's a sobering thing. It's going to take a while to realize my vision. But we're trying to chip off little pieces of it and do the little pieces first, because that's always the way you have to do things. It's a great question. Yes?
You've talked about innovation in the sense of faster, cheaper, better. Any thoughts on how we might go about simulating novelty, qualitative innovation? The new products that we currently have no expectations about because we can't even conceive of them. The new moves in the game, the new rules.
Well, so I think that's pretty hard, and I think so I don't think we're going to get detailed ideas about that. It's like my talk tomorrow, I'll be emphasizing the analogy between technological change and evolution in the biological sense. And if you look in evolution in the biological sense, we know a lot of the basic rules under which it operates. And I would argue that we've even seen certain evolutionary trends through time, but we don't know the details of what's going to pop out. I think that would have been very hard to predict. Similarly, I would never want to claim that I know, the newest invention, and have been dramatically wrong several times. A friend of mine went to the Homebrew Computer Club in 1976 while I was busy building the first wearable digital computer to beat the game of roulette. And he came back from the Homebrew Computer Club and said, oh, I just met these two guys, there were these two guys there, and they had this board, and they were talking about selling computers to housewives. They're going to get, you know, sell tons of computers to housewives. Oh, that's ridiculous. What are housewives going to do with computers? Well, it was Jobs and Wozniak, and they got a lot richer than we did beating roulette. So I'm known to be wrong. But I do think we could have simulations where we could think about the basic patterns and mechanisms and the things I threw out at the end of my talk. I don't want to imply that we're going to predict the latest things that are going to emerge, but I think we can at least think about the consequences a little bit of what it's going to be like. How do we regulate the digital economy? We have to have simulations of the digital economy that we can at least play around with regulatory mechanisms and see what they do. We need a little lab to experiment with. And that's the kind of thing I think we could do. And I know of your work in that kind of thing, so. Yes?
You said at the beginning that you were going to talk about risk and uncertainty, but maybe not so much catastrophe.
Yeah.
So one thing that does occur to me is that when you have your models that you're looking at business cycles, the question you seem to be interested in is what causes the market to start falling.
Yeah.
And there's another interesting question, which is what causes it to stop?
Mm-hmm.
And what is the risk that you get no stop?
Mm-hmm.
Now we've the steepest, the furthest fall we have is probably the 1930s depression, and it did stop after about a third of GDP was lost in the US. But do we know what it is? Do your models help you understand what it is that when you get a bust, that actually stops that and makes sure that it doesn't just keep on going?
Yeah.
And
yeah, so you get a feeling for that. I'll answer this on two different levels. Say if you take our housing agent-based model, I mean, there what happens is you get a bubble started because, for example, the government or the banks start lending on more generous terms. So you have a lot of new buyers entering that were previously out of the market. They create a wave of demand, which drives prices up. In our model, agents use trend-following expectations. So they now assume that because they've seen a trend of the market going up, it'll keep going up. That makes it even more desirable to get into the housing market. So more people pile in, you get a wave going. Now, where does that stop? It stops when you run out of all these marginal buyers that were excluded before. At a certain point, that pool gets exhausted. And we think that's what happened when the bubble peaked in 2007, 6 and 7. And then prices fall again because the trend following expectations start to go in the other direction, and then the herd thunders back the other way. Now, that's of course not the worst that can happen. If you start combining economics with other stuff like war, you can get really bad things like the Roman Empire, when it fell in 440 AD, within a generation, the population of Rome went to 1/10 of what it had been before. The population before is the population of Rome now. Went to 1/10 of it before, of what it was, and then it took, a millennium more or less to climb back. And in fact, Western Europe took a millennium to climb back. And so you can have very sustained, long-lasting crises when you start mixing economics together with other stuff. And so we can have, it's still not destroying the world, but it's a pretty serious kind of things can loom on the horizon when society stops breaking down. I have I sometimes reflect on what would happen if the economy just suddenly collapsed in the sense that we couldn't make anything anymore. If somehow it all just got destroyed. Every machine got destroyed. But suppose we still had all that knowledge. What would it take to get it going again? Even knowing what it is that we want to do and what's possible. I mean, when you start thinking about all the steps you have to go to if you get rid of every tool you have, do everything from scratch, it's just completely mind-boggling. So it's a little bit maybe off the topic, but
so
anyway.
Does it get kind of interesting when we mix economics with what you're calling other stuff.
Yeah.
In other words, a richer portrait of reality.
Yeah.
And I think what you're really talking about is the intellectual journey that economists have reluctantly been on, moving away from the 19th century intellectual straitjacket of their fixation with equilibrium.
Mm-hmm.
So what's much more interesting are the dynamics of these systems and the possibilities that the systems can flip from one state to another, apparently unpredictably. Now we have massive computational power, and we can generate data and we can simulate data.
Yeah.
So we have the intellectual as well as the computational capacity to build a much, much richer description of the world. And equally, when we look to the future, not simply to get fixated on predictions, which are going to be limited because of the complexity of the models we're speaking about, but families of scenarios.
Yeah. So I mean, you're articulating very well my thinking here. I mean, I don't want to bash economists. They've done the best they can. You know, it's a very difficult problem, and actually some remarkably useful things have emerged. But at the same time, you're just articulating what I'm saying here, that if we really use the full potential we have, which would involve not just the economy, but coupling to other social phenomena, I think the potential for what we could do is enormous. Now, the danger is also significant. We have to worry about things like confidentiality of data, which has to be protected. We have to worry about, you know, forecasts being used for the wrong purposes. But I do think we increasingly, really my main pitch in my talk here is that we have to start modeling our collective behavior. You know, global warming shows us the kind of dangerous things we can hit if we're not careful. The surprise with which Donald Trump's election came about and the way in which social media got perverted is an example of a social phenomenon that some people had warned about but was not fully foreseen, and I think we could be modeling much better than we are. And we need to start combining these things together.
We do, and I really like your courage of coming in as a physicist, because you can ask the questions that maybe some economists don't. I trained as an economist in Oxford, and I stepped aside from it because I felt fundamentally we were just rearranging the deck chairs on the Titanic. It was not truly enabling us to ask some of the big questions we seriously need to address, which you did put up on your slides, like how can we really have exponential growth on a finite planet? What are we going to do about having at last reached an agreement on climate change? It's been painful negotiations year on year out, and now one of the major players looks about to pull out.
Yeah.
How then can we achieve the collective outcome that we still want? So we need economics to have the real agency to help us address some of these big questions.
You know, so economists are worrying about them. I mean, Partha Dasgupta, who's sitting there in the audience, is one of the, you know, people who's been on the forefront of looking at these kind of things. But I, at the same time, think we need more effort and dramatically new approaches. And actually, I'm, as we speak, struggling to finish a grant proposal to do just that kind of thing, you know, to make an economic model with a simulation model with much more fine-grained demographic information in it that allows out-of-equilibrium assumptions, that makes what I think are more realistic assumptions about technological change, and that couples more different things together and allows us to think about socio-political and psychological scenarios for groups of people and tribalism and so on, but looking at the economic and technological effects. Now, I have to say, hopefully the reviewers of that are not going to watch this talk, but at the same time, I'm shitting in my pants finishing the proposal because I know how hard it's going to be, particularly if we don't get a budget that is generous enough to let us do it at the scale that these really difficult problems deserve.
Yes.
So, yeah.
I'm afraid we've reached the end of the formal part of this discussion, although I think you said
it's a good place to end.
Stay around if people want to ask you any more questions. But just a big thank you to Doyne for the talk and Q&A.
Thank you. Thank you.